Welcome to the channel. I'm James, and today we're looking at Viacom, CBS Inc., ticker symbol VIAC, and they have had a massive tumble after earnings. Was $35 a share yesterday, is now at $28 a share, which is a 21% drop just in today alone. Now, why is this? Well, two reasons. Firstly, they missed on earnings. We're going to be talking through that today, going through their latest earnings. But also, they had a big name change. They are now known as Paramount, or will be known as Paramount. And the market has reacted poorly to this. So we're going to be going through these latest earnings. Then we're going to be looking at sort of a breakdown of the previous years to see what the company's been doing. And then finally, we'll be looking at my fair value of the company using discounted free cash flow and the Buffett-Graham intrinsic value models. Is this stock a buy right now, even with this drop in 2022? So first, can you please subscribe if you're not already, because you will miss out on these daily stock videos. So let's have a look at Viacom share price. What has happened? Well, as I said, it's down to $28 a share, down from 35. And if we just take it out a little bit, this is the lowest it's been in basically since November of 2020. So it's had that massive rise, drop down in March, and then has been sort of flat and then a massive decrease once again. The stock was rebounding, but this latest earnings miss has caused the stock to go in free fall. So this is pretty much the lowest it's been since the recovery of the March 2020 crash, which is absolutely crazy. Is this the right buying opportunity time? Well, let's just have a look at the earnings. So firstly, we have the 3 months ended in December 21 and then 2020, and then they have the 12 months to the right. What's happened with revenue for the quarter compared to 2020? It is up 6.8 billion to 8, so that is good news. And the revenue for the year is also up 25.2 billion to 28.5. So that, by my mark, is a pass. If we just compare it to the previous years, this is the revenue for 2018, 2019, 2020. You can see revenue is up. This trailing 12 months isn't correct because Yahoo Finance hasn't updated it correctly or updated it yet. But you can see that it is up and steadily increasing. So it's actually highest it's been since 2018 with 28 billion. Next, what we want to do is look at the net income. And how do we get from net income? Well, we look at the revenue minus expenses. What's happening on expenses? We'll just look at the 12 months. You can see they're all slightly up. Operating is up by about 3 billion. Selling, general and admin is up by 1 billion. Depreciation and amortization is actually down, and so is the restructuring of the corporate matters, but these are very small compared to those two. So overall, expenses were 21.3 billion and is now 24.6. What does that mean in terms of net earnings? 2.4 billion in 2020, 4.5 billion in 2021. And if we compare it to the quarter, 810 million to now 2 billion. So that is a massive increase. Once again, if we have a look at the Yahoo Finance, profit is up massively. It's in fact higher than it was in 2019, and they've managed to generate more profit from the revenue, as revenues were quite similar, but we're up to 4.5 billion in profit. Now we are going to look at the shares outstanding. Shares outstanding are here. Are they issuing new shares? Why is this a negative? People always say, well, if you have one share of a company and there are 10 shares, you own 10% of that company. If the company buy back 5 shares, you would now own 1 out of 5, which means you'd own 20%, which would be better. You'd have more of those profits. If the company issued more shares, you would then lose your percentage stake in the company. So we want them to be not issuing more shares. Let's see what Viacom have done. Well, unfortunately, if we look at the 12 months December, they had 618 million shares and now 655. So they're issuing new shares. Sorry, I was looking at the diluted there. 616 to 641. So they are issuing more shares. And if we quickly go back to Yahoo Finance and look at here, they actually have been relatively flat. Very big offering in 2019, almost doubled the shares. And now in 2020, they have increased it once again. So that is a negative there, that they are issuing new shares. And finally, we are going to look at the free cash flow. So let's go to the cash flow statement. How do we get free cash flow? Well, we take operating activity, net cash flow from operating activity minus capital expenditures. So we see this here on the net cash flow from divided by operating activities, 2.2 billion in 2020. This is just the year ended, and now just shy of $1 billion in 2021. And to get free cash flow, we take away capital expenditures. Capital expenditures are pretty much the same, minus 324 million compared to minus 354. So that gives us a free cash flow of around about 600 million, which is down massively from the 1.9 billion we had in the previous year. So if we just go to Yahoo Finance again, Yahoo Finance will give us the free cash flows. As always, ignore this first number. So this is one of the lower numbers. In fact, the lowest number they had, 2.1 billion, just shy of 900, just shy of 2 billion, and is now at 600 million. So that is a negative there. So what does that mean in terms of free cash flow ratio? Well, they have a market cap of around about 18.3 billion, 600 million in free cash flow. That's a free cash flow ratio of about 30. They do pay a 2.74% dividend, which is an ex-dividend date of the 14th of March. So buy your shares before then if you want them. And they pay about $500 million in dividends. The dividend is safe, but barely. Now, if we have a look at the models here, we've got the free cash flow estimated based on the previous years. And what does this give us a value of Viacom? Well, if we look at that, based on these estimates, which are not exactly the most crazy estimates in the world, they are going back to 2020 numbers and increasing. That would give a calculated stock price of around about $80 a share, which is a long way away from where it is right now. If we just have a look in terms of this, the company itself is only worth $20 billion and it has 4.5 billion in net income. So that is what, a P ratio of about 5. That is pretty good, but the free cash flow ratio, as I said before, is a lot lower. So the discounted free cash flow models is saying this stock is massively undervalued. Now, if we look to where they were previously at $78 a share, I mean, that was on that massive run up until March. So the stock has been there before. Even at sort of 2017, 2018, 2019, it was not a million miles away at $50 a share, but it still seems a far cry from $28 a share right now. So what does the Buffer Intrinsic Graham value model say? This takes earnings per share and expected growth rate into account, and the expected growth rate is minus 6.5 for the next 5 years. So what this will do is it will spit out a negative number, minus $22 a share, according to the Buffer Graham Intrinsic Value Model. They do not like the stock, but obviously this is a negative growth rate. So even if they were to grow at 1% over the next 5 years, it would still say the stock is undervalued massively. This is because of this high earnings per share, which would put it at a value around about $53 a share. But I would not take too much in that, as analysts are saying that they are decreasing in terms of general growth. So overall, discounted free cash flow model says to buy. Buffer Graham intrinsic value, not so much. Let's have a quick look at some of the technicals here just to round out the video. We'll go to the year, and I imagine we will see some pretty negative stuff. What I'm going to do is I'm just going to add the 200-day moving average for right now, because the stock has had a pretty bad run recently. And what are we seeing? Yep, there you go already. The stock is way below the 200-day moving average, which is a very, very bearish sign. And if we look at the 50-day, just to sort of give us some golden crosses, yep, there's your death cross. The price has dropped below the 50-day, which is also a massive negative point there. The death cross happened back in June, and right now the price is way below the 50-day moving average. So those are very, very bearish signs. The next thing we want to look at is the MACD. What is that telling us? Well, we're looking at the daily level right now. So the MACD has just recently switched. This is signified by the signal line and MACD lines crossing, and then obviously on the histogram as well, red means it crossed at the same time there. So that is a bearish sign. On the positive, the MACD and signal line are above the zero line, which is a bit bullish, but it looks like it's swiftly about to cross over into the negative side, which it did back here. It did there in September of 21 and continued to do so up until this little price movement here in January. So that is a bit bearish again. And finally, we like to look at the relative strength index here, RSI. What is this saying? Is the stock in overbought or oversold regions? So it was trending in the overbought region just before, when it was $36 a share, was a bit higher, but has now dropped massively into the oversold regions. Now, if we look at Viacom on the dailies, when it's been to this previous amount, it's only been in oversold recently a few times, and we have seen some good movement to the upside. Here is another example. There is one. This was probably a good example again, and here. So they've had some good price movements, but the stock really has been in the oversold regions more than the overbought regions. And if we just look at the weekly, which gives us a bit more of a long range story, well, there you go here. The Viacom up till 2018 to 2020 was pretty much never going below the oversold regions, dropped down the pandemic, good buying opportunity, but then was very, very high here, which did spell trouble, and is now sort of trending on the more oversold regions than what it was previously. So the technicals, I don't like it from a technical level. Obviously, this is a good buying opportunity potentially if you do like the stock, but I would say these free cash flow models do tend to overvalue. So very interesting regardless. The name change, everything, it's not looking good. But if I was to trade this company out with another company's name and look at that balance sheet, look at that free cash flow, I would probably be very happy with it. But Viacom, market doesn't care so much. So thank you very much for watching, guys. Please give a like on the video if you enjoyed it. Subscribe if you're not already, and I'll catch you guys next time.